Hello, everyone. I think, Ibrahim, I think we should start now. We have a sufficient number of participants and more will be joined, I think, in a while. So, thank you so much, everyone, for joining. Myself, Salman Ishan, Regional Director of IFA and IFA for Saudi Arabia and Bahrain. You can hear me very well? Ibrahim, you can hear me?
I can hear you, Salman, but your voice cut down after small sentences. I don't know what is the issue. There are some, I think there are some barriers to the communication.
No, is it fine?
Yeah, who?
Yeah, it should be okay now. Uh, okay, we'll just we can start now. Just to give a background. Last time we had this topic like on 18th of April, on 8th of April 2023. We started this topic which is IFRS 15. Uh, Basically, it's about revenue recognition, and I can say we can cover half of the topic in our last webinar. So this is the second webinar for the same topic to complete, and I can hand over to Ibrahim. Ibrahim, let me share my screen and then you can start. Meanwhile, you can give your introduction, maybe if some participants are new.
Okay, Salman. Salman, if you want to introduce me a brief introduction, you can start it with it, and we can
Yeah,
start from the
and
new.
as whosoever has joined last time, they know Muhammad Ibrahim was our presenter in the previous session. So Ibrahim is professional accounting affiliate from the Institute of Chartered Accountants of Pakistan, and he has a diversified experience in the field of accounting and finance and financial modeling. Currently, he is working as a group consolidation and reporting manager in Al Mozaini Real Estate a development company, and previously he was working with RSM as well as Deloitte, uh, Pakistan as well as Middle East. So, yes, over to you, Ibrahim.
Okay, thank you, Salman, for the introduction. I hope everyone can hear me correctly, so I can start now. Please reply on the comment section that if everyone can able to hear me correctly, loud and clear, then I can start from the remaining session which we have left previously.
So, you can see my screen, everyone.
Yes, sir. I can see your screen. Yes, we can hear. Yes, we can hear. Okay. I think my
Super,
voice
let
is
me
clear
share
now.
this.
Salman, you can move to the slides which we have left, so I can start from there.
So, we just last time finished step two, which is the identification
Yeah,
of performance obligation.
I prefer to be remain on this step two, so I can give some recap and we can move forward. Okay.
Yeah.
So, guys, as a recap from the last lecture, what we have discussed in the last lecture is that what was IFRS 15, why IFRS 15 came into being, what are the necessary things because of which IFA, IFAC, and IASB needs to introduce IFRS 15, and and all the previous standards, that is IS 18, IFRS 11, and other interpretations were ruled out after IFRS 15 came into being. IFRS 15 gives a simple idea to how to recognize a revenue. IFRS 15 gives us five-step model, right? IFRS 15 gives a five-step model. And what we have discussed the step one. Before recognizing any revenue, that is, first we need to identify the contract. And then we come to step two. In step two, we understand that what are the performance obligation, how to identify different performance obligation, what will be the transaction price, and blah blah blah. So in the step two, we already discussed many things which will come forward as when we are determining the transaction price, right? So let's move forward. I was talking about the performance obligations, how to identify the performance obligation, what is performance obligation. We have several question and answer sessions that everyone, alhamdulillah, participated in that question and answer session, in which I have asked you guys about that in a particular example, that what should be a performance obligation. Um, Either there are two performance obligation, one performance obligation. Either we can satisfy the performance obligation in now or over the period of time. So we discuss something. Okay. In the step two, we discuss many things which will be come back after when we go to step five as well. So let's continue from the step two. I also want to tell you something else. uh, Salman, if you can remain in that last slide. Yeah, this thing, that there are also a concept of distinct goods in the IFRS 15. What are the distinct goods and services? Distinct goods is simple, in simple language, is the goods or services which are different from the other goods and services which are to be offered. For example, in a particular revenue transaction, you have been offered by a supplier two types of goods. Okay, two types of goods. While recognizing a revenue, you need to understand either those goods are separate, are independent with each other, or a similar product. If the goods are similar product, then the selling price or the performance obligation will also be the single performance obligation to deliver those goods and services which are similar to each other. However, where the goods or services are distinct with each other, I mean different, there are criteria specified by the IFRS 15 how to understand that the goods or services are different with each other. For example, here if you see in your screen, that focus on part one, focus on whether the good or services is capable of being distinct. This means that customer either can benefit from the individual good or services on its own. That is, good one, good two are clearly independent with each other. Both of the good will give different type of benefits to the customer on its own. They are not similar. If you ask me, please, Ibrahim, please give me an example of it. I can give you an example. For example, you go to a confectionery store and you ask for them to give me 3 kg of rice. Okay, 3 kg of rice. Okay, in 3 kg of rice, you ask them, because in rice there are several categories. What do you mean by several categories? For example, rice. Some rice have long grains, like 1 centimeter, you can say. Some rice have half grains, that is 0.5 centimeter length of that grain. So the prices of those rice as per their types are different. So if you take 3 kg of rice, and that 3 kg of rice includes two types of rices, and which can also be separable, I mean that you can divide them, you can put them apart. It's it's uh, it's doable. Then those two goods are two different types of products, and there are two performance obligation to deliver those two different types of goods. So in this whole scenario, IFRS 15 is trying to guide us that you need to understand, while you are recognizing a revenue, that either the goods or services are distinct or similar to each other. If they are distinct to each other, then you need to understand that the performance obligation is also different and it's not the same. Okay, if I am clear to this, then we can move towards the next slide. Okay, please answer. I want answer from everyone that if I am clear to everyone on this part, so we can move forward toward the step 3. Yes, sir. Yeah, sir. Yeah, yes. Okay. So, okay. Clear. Okay. So, I think Salman, everyone has their understanding, so we can. I think we can move towards the next slide.
Yeah. Okay.
Okay. Okay. The step 3 is basically determining the transaction price. We already discussed step 3 in our previous lecture as well. Meanwhile, while we are discussing the step 1 and step 2, what is the transaction price? I am reading a definition and then I want the answer from everyone to give me. Salman will open their mic that what they understand about the transaction price. Okay. After you identify a contract and then you identify how many performance obligations are there, now you need to understand the transaction price of the whole contract. Transaction price is the amount of consideration an entity expects to be entitled to in exchange of transferring the promised goods or services. Okay, this is the definition. Now I want the answer from your guy, anyone who can participate voluntarily, who can give me his explanation or understanding of the transaction price. Please raise hand so Salman can open their mics.
Right. Meanwhile, I have to adjust the screen. Just give me 10 seconds. If
No issue, no issue.
Okay, now is it visible, Ibrahim?
Yeah, it's visible.
Okay. So question answer or if people has raised their hands so far. Yeah, no one.
I don't know if in everyone,
Yeah,
yes,
Krishna
there is
is
a
here.
one.
Yeah. Karthik.
Karthik is raised hands. Yeah, yes, Karthik. Karthik's mic is unmute now. Yes. Yes, Karthik, you can speak now. I don't think if you can hear us or not.
Okay, let's move, Ibrahim.
Okay, I can move. Can everyone answer that everyone is able to hear the screen and there is no distortion, so we can continue. I think there are some distortion. I don't know. Okay, let's move. I
I
can
can hear you
explain.
clearly.
Yeah.
I can hear you clearly.
Okay, let's move. The the transaction price is basically very simple. That you have identified a contract. You have identified all the performance obligations. Okay, then what are the performance obligations that are clearly identified in a contract? then then you need to understand what is the total transaction price of the contract. Determine the transaction price is also the most difficult part while calculating the revenue when IFRS 15 came into being. What is mean by that, sir? This means that transaction price is simple, is a consideration. Like I can't like for example, company A contracted with company B to and company A promised to deliver some goods or services to company B. In exchange of that promise, company B promised to give the consideration. That consideration of for the promised goods or services is basically called a transaction price. I think it's very clear. Now, what is the difficulty, sir? You are asking. The difficulty here is that it's not that simple that a mere consideration you can identify it's a transaction price. There are implications, there are effect. For example, the consideration may be cash, maybe in cash, or maybe in kind. The consideration may be in cash or maybe in kind. For example, company A offers company B to deliver some goods and services. In exchange of those goods and services, company B promised to give his apartment, for example. So the consideration offering by company B is not in cash, is in kind. So how will you track or determine that what is the transaction price of my contract? Similarly, consideration can be variable. Like for example, company A promised company B to give 1 ton of for example to give 1 ton of wheat every month. This is a contract that company A will deliver 1 ton of wheat every month for the 2 years, and in exchange of that, company B will give him a certain price after the end of month. After the end of month, okay, but it depends on the inflation and the price fluctuation, that the price can be vary on the each month. So the price is not fixed for a particular quantity of wheat. So that consideration is variable. So how will you determine the total transaction price of the contract? Similarly, if company A offers company B some discount, rebates, refunds, returns, then what will be the impact of those debit credit note transactions onto the transaction price? You need to consider, you need to check it. Similarly, at the end, if the consideration to be paid by the other party, not now but after more than 1 year or after more than 12 months, then there is a financing component involved, which we already discussed in the last lecture. That is called significant financing component, for which IFRS 15 gives us a particular guidance on that. So determining transaction price is not that easy, that a mere consideration cannot be considered as transaction price. So there are four elements which will always affect our transaction price, that is variable consideration, any refunds and rebates, significant financing components, or non-cash transaction, which we will discuss in the later slide. Salman, you can move to the next slide. If anyone has the question, they can raise their question in the question answer section, and we can answer them later. Okay. Now come towards the accounting for variable consideration. Variable consideration also includes any bonuses, any penalties, or any contingent payments, any refunds, any discounts, which will come lately in the later months while the whole contract in progress. Like for example, he promised you. For example, he promised you if you buy the quantity of a particular good from me for more than 6 months, then I will offer you 10% discount. Okay, and the contract is for 1 year. This means the discount will be taken. Similarly, Similarly, it is implied that if you go with a particular contract, then there are chances of getting some penalties because of legal implications. Anything, any anything there may be anything which affects your consideration later in the period while the contract in progress. So how will you account for IFRS 15? IFRS 15, what is the basic concept of IFRS 15 regarding the variable consideration is that they IFRS 15 is asking us to estimate the impact of variable consideration and adjusted that impact into your transaction price on the current date. For example, if the contract is for 12 months, even then you need to determine the transaction price at your current day, means day first, while you are executing the contract. So for example, for that IFRS 15 guides you to prepare an estimation that what will go wrong, what will happen, what is the probability of something to happen and something not to happen, and then by that by that probability analysis you can come with a expected value of your variable consideration, which you will adjust onto the total consideration price on day one, which is then your final transaction price, which will be allocated to your separate performance obligation. I hope I know it's a bit complicated, but I hope it's clear. Like if I cannot give you, like I cannot calculate the examples in front of you because it's just a lecture for 1 or 2 days, and we cannot go with a long detail on this method. There are separate classes for that, but I can give you some references that from where you can go for those examples and you can easily clear your mind. uh, Wajid is raising his hand. Salman, Wajid, you can write question. You can write your question there, and we can answer you. No issue. So IFRS 15 gives two types of method while calculating the consideration variable consideration. That is expected value method and single most likely amount. Expected value method is based on the probability weighted average amounts within a range for a larger number of similar contracts. Like if if the similar contracts are already there in the market or with you as well, you can take the history. Like for example, if in your contract there is a implication of discount, that if the company goes with this amount of quantity, then they will charge a discount on to the supplier. So from the similar contract you can understand the history that either the other company will go for the discount or no. So you need to assess the probability 30%, 20% based on your historical records onto the weighted average amounts, and then you can come with a expected value while calculating those probabilities. The other method is the single most likely amount, the amount within a range that is most likely to arise, where the contract has only two possible outcomes. It is very rare. Either that can happen, either that cannot happen. So no one is referring this type of method while calculating the variable consideration. The expected value method is most likely to use by the global world, that go for the probability, go for the historical data for a particular variable consideration. That can be rebate, that can be discount, that can be concession, that can be penalties. And from your historical records you can consider that how much the probability or how much the chances are there to calculate such kind of any credit transaction, which will affect your total transaction price, and that will be your expected value. I think it's clear. Okay, so we can move to the next slide. Salman, if anyone has the question now, they can ask me. can you please give an example for single most likely amount? Okay, Zaryab, I can give an example for the single most likely amount. For example, first, um, give me 1 minute. Single most likely amount example I can give you. For example, company A, company A gives you company A. Okay, company A contracted with company B to provide 50 labor force, 50 labor force for the 1 month. This is the contract. Okay, okay, and company B company B agrees to it that they will give them the 50 labor force, 50 labors for 1 month at a consideration price of 100,000 Saudi riyals. Okay, and there is a condition attached to it. For example, there is a condition attached to it that if those 50 laborers will work more than normal working hours, that is the 8 working hours, then company B gives a 10% discount to company A. For example, okay, this is the contract. Now, the company will check the chances that either those labor company B will check the chances that either those labor or those workers will work more than 8 hours or not. So there are one likely outcome that either there is a chance or there is no chance. If we go with this method, like this is a method, na, single most likely amount. 10% discounts will be calculated as 100,000 Saudi riyals multiplied by 10%, that is 10,000 Saudi riyals. So they need to understand that it is possible or not. They will again go to the history, but they will not check the probability. They will just come with one outcome. Either they will work or either they will not work. That is why I'm telling you globally, this type of method is not normally used. Like if, like for example, if company B consider that they will not work, then there will be no discount. And if company B consider estimate that they will work, then there is a total 10,000 Saudi Riyal discount. Unlikely if they go with the expect value method, then they check that how much is the probability, how much, then they need to understand that how many labor workers need more money, how many labor workers have good age and everything, so they can work more than 8 hours. So then they impact those probability analysis to that amount, and then that the factor will create, and that factor will be multiplied to that 10 to the discount amount to understand how much the consideration will be affected. Okay, I give the answer. Salman, we can move to the next slide. I think so. Okay, consideration payable to the customer. This is includes cash paid to the customers as well as credit or other items such as coupons or vouchers. And account is a reduction in transaction unless payment is exchanged for goods or services received from the customer, in which case no adjustment except the concession paid exceed the fair value of goods service. Here is also a type of discount. For example, here this you can say it's also like a discount or something. For example, for example, a supplier, for example, a supplier gives you, for example, a supplier gives you a voucher or a coupon which a customer can use on a later date to get benefit with. It's a very common example. I will not go into detail, but because it's a bit difficult scenario, but I will give you an example format. For example, if you go to any theme park in now in the current now in current scenario, if you go to any theme park, they will they will ask you a particular amount which they will charge to your card. Okay, but while while you were enjoying the rides, you may get benefit from a particular vouchers, and that voucher can be redeemed on a later date from by particular Saudi riyals, or you can redeem those vouchers and buy anything. So this is basically that voucher is basically a liability for a supplier to be paid to the customer if the customer comes on a later date. Okay, so the most important thing to understand what is the consideration payable to customer. If you guys get it, then I'll let you know how to calculate and how to adjust your transaction price with that. Okay, how there is a question: how do you determine the weight to attach to the range of similar prices in an expected value method? How do you determine the weight to attach to the range of similar prices in expected? I did not get your question, but I can tell you something. You can we can open your mic on later in the session. But what I understand is that currently I am not allocating the transaction price to my performance obligation. First, most important thing, I'm not allocating my transaction price to the performance obligation. I am just calculating the whole transaction price of a contract. Later, I will go with the dividing or allocating my transaction price to each performance obligation, which is different thing. Okay. So expected value method is just a method by which you can assess the probability analysis and then calculate the impact or the effect of your variable consideration to the transaction price. That's it. That is my answer to your question. But later in the session we can discuss more on that as well. Currently, I asked everyone that if you guys have understand what is consideration payable to the customer, then I'll let you know how to calculate the effect of that consideration payable to the customer and adjust into your transaction price. Please give me yes or no so we can move forward. There are no answers today. I don't know. Abdul Karim Abbas, you okay? Zaria, Heather, clear. Okay. So people are listening. Let's go ahead. Okay. So this is the consideration payable. Okay, like a vouchers I told you. How will you calculate the effect of those coupons, vouchers, or those that consideration payable to customer? That is the liability to the supplier towards the customer for a future date. Again, you will go to the same thing. Here I write here accounting for as a reduction in the transaction price unless payment is in exchange for a good or services received from the customer in which no adjustment is made. I'll let you know, except where the consideration paid exceeds the fair value of the goods or services received. The difference is set against the transaction price. The fair value of the goods or services cannot be reliably determined. Full amount taken against the transaction price. Okay, these are standard wordings. I'll let you know what is happening here. I'll give you a simple example. For example, you give a voucher to your customer while he was using your services in a theme park. And from those vouchers, he can redeem them at a future date and claim his benefit either in cash or either in kind that he can buy anything, any toy or anything. Okay, how will you now please understand this thing, that this liability is basically should be reduced from your transaction price now. Okay, but currently you don't know how many customers will come back and redeem those vouchers. You don't know that on the current date. So the big question is that how much amount you will reduce from your transaction price. For that, you need to again go through the expected value method, that is the probability analysis and everything. So for that, first you need to assess the probability that how many customers based on your historical records, industry similar records, and your judgments. It includes judgments always. That what will be the probability of the customers coming back, and how many customer will redeem the voucher and how many customer will not redeem the voucher. Okay, and then you need to assess the fair value of that particular consideration that to be paid to the supplier at a future date. That fair value may be, you can assess the fair value based on the consideration. Like fair value can be anything. If you are giving them a voucher to buy a certain toy, then the toy should have a fair value in the market. Or if you are giving your customer a voucher to redeem any toy, but that voucher contains a value which is equivalent to some currency, then that currency is its fair value. So first you need to assess the fair value, and then that fair value will be multiplied to your probability analysis, and then you will come with a particular expected consideration to be paid to the customer at a future date, and that amount will be reduced from your transaction price at a current date. The simple game. Okay, I know it's complicated, but I hope I make things simple and make it clear to you. So I think we can move forward now. Okay, now determining the transaction price is clear. I am now coming towards the allocation of the transaction price to the performance obligation.
Ibrahim, we have questions. If you can see, Daniel.
Okay, okay. Where is the question? How to account for contract modification for change in scope or price? If change in scope, whether it should be accounted as a separate contract, if it is a distinct goods. Okay. Daniel, first of all, I'm not in the current lecture and in the previous lecture, I'm not covering the modification part in the RS15. I'm just expressing the revenue recognition criteria here. But just for a brief overview, I can give you an answer about, because Daniel has asked about the contract modification, that if there is a change in scope or price, and if there's a change in scope, whether it should be accounted for a separate contract or if it's a distinct goods. So this is basically a totally different aspect of IFRS 15 and its contract modification, which we are not covering right now. But I can give you something about it, like if the modification is because of change in scope, you cannot change in scope or change in price, then it can be considered as a modification. But you need to understand that the change in scope is particularly because of this distinct goods or not. Okay, is a distinct goods or not? And if there is a change in change in scope, you need to understand the change in scope. Change in scope normally means that the performance obligations may have been increased. Performance obligation under the contract may have been increased, or the period of the contract may have been increased. And again, after the change in scope, you also need to understand that the for the performance obligation is of different goods, then the contract will not modify, and then you need to create a separate contract. You are right on it. But there are many implications and many things to understand, and I cannot give all the details right now because I am covering the step 5 model in my two lectures. We can go for a contract modification separate lecture in the next session when IFA organize. But currently, I cannot give you the detailed analysis. You are right that if the goods are distinct, then we need to to go for separate contract, we cannot modify as previous contract. Okay. Allocation of transaction price to the performance obligation. As in step 2, we already discussed about the performance obligation. There are different types of performance obligations which are identified on the contract. Can be, there are different. So when you have identified the contract, when you have identified all the performance obligations, and when you have determined and calculate your transaction price for the whole contract, now it is a turn to allocate that transaction price into your each performance obligation. And how will you do that? You will do that by using a pro rata basis, by using a proportionate method basis, but on the stand-alone selling price of each performance obligation. Sir, what is the standalone selling price? If you remember in the previous lecture, we already discussed about the standalone selling price. That what is the standalone selling price? Why IFRS 15 is more emphasizing on a standalone selling price. Standalone selling price is the selling price of a particular performance obligation, not a whole performance obligation. Because the performance obligation can be of different types of goods, distinct goods. As we already discussed, the performance obligation can be different in a particular single contract. So we need to assess the what is the standalone selling price. Normally, it is not easy to assess the standalone selling price. For example, I go with I go with normal. For example, I go with a normal last our last example that I bought a car only. I bought a car from a company, a dealer who promised me to deliver the car and also promised me to give me a 2-year maintenance services on a single price, that is 100,000 Saudi riyals. But we confirm that in this contract, transaction price is 100,000 Saudi riyals. But the performance obligation, there are two types of performance obligation. That first performance obligation is delivering the car, and the second performance obligation is giving a maintenance service for the 2 years. So, okay. So, if I ask you what is the stand-alone selling price of car and what is the stand-alone selling price of maintenance for the 2 years, you need to assess that. You need to assess that because you need to allocate the 100,000 Saudi riyals transaction price and allocate that transaction price into both performance obligations. Agree? Why? How can you do that? IFRS 15 gives you three types of approaches to do that. Adjusted market assessment approach. Very simple. You go to the market, you can check that how much the cash price of this particular car and how much is the, if you go for maintenance of a particular car, how much it will cost you. So it is an adjusted market assessment approach. Was first approach. The other approach, what is the cost of giving the maintenance plus your margin, and what is the cost of car and plus the margin, so expected cost plus margin approach. The third one is the residual approach. The residual approach is very workable. For example, you did not find anywhere the actual cash price of the car, but you can find the selling price of a maintenance services for the 2 years. For example, if you go from any mechanic shop, you ask that I need 2 years maintenance services for my car, he will give you a quotation of 10,000 Saudi riyals. So from the 100,000 Saudi riyals, if you reduce 10,000 Saudi riyals as a maintenance selling price, then the 90,000 Saudi riyals is for a car price. And residual approach is that after reducing all the observable standalone selling price, whichever whatever is left is the residual selling standalone selling price for a particular performance obligation which is not observable in the market, which I explained you just now. So by doing this, you will come up with all the performance obligations Okay. Well, or you will come up with all the standalone selling price of performance obligation, and then you can allocate the transaction price to your performance obligation based on that. Okay, clear? So we can move to the next slide. Salman, I think we should move to the next slide. Similarly, the discount here. Back, Salman, back. Previous slide, please. Salman, previous slide, huh? I think so.
Sorry, Ibrahim, which slide?
Previous slide.
Okay.
Okay. Similarly, now you understand what is the standalone selling price. Now, if there is a discount in the contract, then you also need to understand that for all performance obligation, you need to prorate the discount for the transaction price into all standalone selling price. Unless and only if you know that the discounts is for a particular performance obligation, not for the other performance obligation, then whole discount will be allocated to that standalone selling price of a particular performance obligation and will not be allocated to other performance obligation. If we go to the next slide, allocating the variable consideration, variable consideration is allocated entirely to a performance obligation. Both, I can give you, this is also the same. The variable consideration, as we discuss later, we will calculate the effect of variable consideration and then we divide that effect into all the standalone selling price, unless only if we can conclude 100% that variable consideration is not a part of a particular performance obligation, and that part is clearly distinct from any other performance obligation. Okay, so we need to allocate that variable consideration from the standard selling price while allocating the transaction price to the performance obligation. Next slide. Next slide. Yeah. So now I think everything is clear that on the step one, we identify the contract. On step two, we identify the performance obligations under the contract. And step three, we understand how to determine the transaction price of the contract. And step four, we understand how to allocate the transaction price to each performance obligation. Now we need to understand when to recognize the revenue. This is the
Uh,
step five.
Ibrahim, we have two questions.
Okay, let me see. Okay, there is a question. In a service oriented business like digital marketing business, social media marketing campaign day for 3 months. How certain price say $100 could be allocated to performance obligation for revenue recognition. On the contrary, how cost say $70 could recorded for 3 months campaign. Okay, can you open the mic of Suleiman? Salman, I cannot understand this question.
I think he wants to say whether they should record campaign revenue over the 3 months, or just they have to just record the cost up to 3 months, and then after completion of 3 months, maybe revenue.
So,
Anyway,
like,
let me
it's
see.
unclear. That's why I'm asking you to. I understand what are you saying, but it's still unclear.
Yeah. I just opened up his mic.
Okay,
Hi
Suleiman.
everyone.
Hi.
Actually, my question here is about the digital marketing businesses.
Okay.
Usually, we have multiple kind of services on digital platforms like Facebook, social media, Google, search engine optimization, and these kind of services. Let me give you a very simple example. For example, there is a campaign we have to run on the Facebook over 3 months, and we have agreed price with the client, $100, for example, and the campaign will run over 3 months, and the performance obligation is linked with the 3 months campaign over the period.
Okay.
Our obligation is to run the campaign on Facebook for over 3 months. So now suppose there is a cost
Okay.
of this campaign. Internally, we have allocated the cost, for example, say $70. So $30 is our profit.
Okay.
So how are we going to recognize this revenue and this cost over the period? We will prorate it, apportionate it equally over 3 months, or at the end of the 3 months. How are we going to recognize this? Because client is going to
Okay.
get
Okay,
benefit
Suleiman, now
from the day
I
one.
understand the question. I understand your question, Suleiman. Let me give you it's very simple for the whole people who are listening to me. The most important thing to understand here in IFRS 15, whenever there is a service revenue, whenever there is a service revenue, first the most important thing you need to understand that revenue related to service is recognized only when the services are rendered. Okay. Now, in the case of Suleiman, like you are giving the campaign, you are running the campaign for the Facebook for the 3 months. Okay. So yours, if I can divide it, normally it's not a point in time, but it's a straight line concept. I can give you it's a straight line concept. Like for the you will charge a I don't know like I what I understand is that 100 Saudi riyals per month or 100 Saudi
No, no,
riyals
it's over three
3 months.
months. Total 3 months price is $100.
Okay, I got. So you need to divide it to by three and record a revenue on monthly basis. If, but you need to understand if at any time we did not render the services, we cannot record that revenue. Very simple. That's not a point in
So
time. It's
simple
like
amortization concept. Cost will be
exactly
amortized and
simple
revenue will be
amortization, straight
amortized
line
accordingly.
concept. Exactly same, simple. There's no complication, no complexity in this performance obligation thing.
So similarly, if we give the ads on the billboards, billboards on the roads. So we
Yeah,
give
yeah.
the ads on the billboards in
Yes,
the
yes, yes, yes.
cinemas. So this will also apportioned over the period of time. Like
No,
if it is
no,
for one
no, no.
month,
It
if it is for
depends.
three
It
months or
depends.
6 months.
It depends. It's now the thing is different. First, you tell me yeah, that's a fixed concept of running the campaign on Facebook, but doing the billboard thing and any other thing, it's the most important thing IFRS 15 is saying is basically you need to read the contract. Like for example, for a billboard, there can be two chances. There can be two chances. Like for example, in the contract, you are hired to build the billboard or place the
Advertise on the
billboard.
billboards, for example, advertised on the billboards. And by the way, we hire another supplier, sub vendor, to perform this billboard services.
There's a subcontractor thing, right?
Yes,
So
yes.
that will be your cost, but your revenue will be depend on the contract with your customer. That if the customer asks you to perform the advertising on a billboard, like for example, 5 billboards per month, you have agreed, and there's a single price they have agreed for it. Then you need to then you cannot amortize it. You need to understand that what is you need to allocate that all transaction price on your billboard, that how much you have identified, that how many billboards you're gonna placed in that amount of period of time. Like
So once we
the
place, we can
case is very
recognize the
simple that
revenue.
you need to understand the contract first, huh?
Once we place the ad on the billboard, so our performance obligation has
Yeah.
been fulfilled, and now we can recognize the revenue.
100%, but depends on the contract. What is written on the contract to place the billboard or to complete the marketing for 1 month. It is very important
One
that
month,
what is
yes.
the
This
wording.
3 months, 4 months, six
Yeah,
months. It's like
yeah,
this.
exactly. If the wording of the contract is doing marketing for 1 month, that it's either the case you are replacing the billboard, you are doing the marketing in Facebook, but the contract is for doing the marketing for 1 month, and you it's a mutual agreement that marketing can be Facebook, that marketing can be billboard, anything. But for the single same price, then you don't need to allocate, because there are not distinct goods. Marketing, we can judge the whole marketing concept as a similar good and not a distinct goods, in my opinion. Then you need to amortize it over the period of time. So it clearly depends on the contract itself.
If I would like
Got
to
it.
add,
So one last thing, just one last thing, please.
Okay,
Similarly,
okay, okay.
for the videography, if we make a video for a client, and that video takes,
Okay,
for example, 2 months to build the video, and then on the third
okay.
month it goes live. So the cost is being incurred every day. Voiceover cost,
100%.
any celebrity cost, setup
Exactly.
cost, this cost, that
Very
cost.
good question.
That cost should also be recognized as cost of sale, or no?
No,
Once we
no,
will
no, no.
recognize the revenue, then we will recognize the cost of sale.
Exactly. The last point is your answer to that, that it's a matching concept. You can only recognize the cost when you recognize the revenue. Before that, all the cost is basically the contract cost, which will be recorded as a deferred cost in the contract asset. Okay, Suleiman?
Yes, I got it. But deferred cost, some people have different concepts. They sometimes the people says if you pay the cost, but actually it's not the period cost, you will consider it as a deferred cost because it's a future cost. If you pay it in terms of cash, but some
Exactly.
people
No, no,
says
no, no.
even you can record the
It's
accrual,
not the cash.
deferred
It
cost
can be
accrual.
payable. It can be payable. No,
It
no.
can be payable. Yes, yes,
It
yes,
is
yes.
wrong concept. If anyone is saying cost is just a cost. If you go to IS1, IS1 is clearly telling you the matching and prudence concept. That when you can only recognize the cost whenever there is a revenue. Otherwise, that cost
Perfect.
is an abnormal cost and it is not a cost of sales. It will be go into your other expenses, not into the gross profit part,
No, no,
right?
we are talking about deferred cost perspective. Deferred cost,
Yeah, no, I agree
we
with
can
you.
also stand the payable against deferred cost.
Exactly, 100%. There can be advance as well, right?
Perfect, perfect, perfect.
Okay.
Ibrahim,
Thank you, brother.
I would like to add on Suleiman's question. He
Okay.
like he was talking about when he was talking about the billboard. So there could be something like as a part of contract, one-off item and recurring items. The one-off item can be like just hanging the flags on the billboard. He can record, I think, at point in time, but keeping that flex over that billboard for next 3 months can be another milestone which can be recorded over the period. So it
Now
depends.
the thing is that as I already told, it depends on the wordings of the contract. If the wording of the contract is clearly marketing and the transaction price is doing for the marketing, and they mutually agreed that either they can go for billboard, either they can go for Facebook, then the whole our whole promises cannot be considered as a distinct goods. I already told in my lecture that the if you need to understand the different types of performance obligation, you first need to understand that the promises are of distinct goods or not. So if as per the wordings of the contract, the billboard, Facebook marketing, it will consider as not a distinct good, then there's single performance obligation. But like for example, if you don't go for the billboard, nothing, and do just normal marketing, you do not agree with them, then there is a case that you need to understand, you need to identify the different types of performance obligation. So it depends on the wordings of the contract, and you can play with the wordings in the contract. I
By
can
the
tell
way,
you.
here there is a conflict in standards wording. Sometime in IFRS 15 standard usually says the end consumer or the beneficiary of the service has utilized their service, then you can record the revenue. Maybe he has not utilized the service or he has not taken the benefit of that service. Is it so?
Mm,
Is it going to contribute?
this IFRS 15 wording is 100% correct, and it is, and the last thing you said, if you I don't know if anyone belongs to telecom industry here. Okay, in telecom industry, for example, uh, there are always service provider. Like for example, in Saudi, there is Mobile, there is STC, there are other service provider of telecom industry. So telecom industry can only recognize the revenue when the person utilized utilized the package, for example. But I did not agree to it. There are several questionnaires with the IFAC on this particular thing, that customer will not come back and ask for you the money back for that package. But as per the standard, it is clearly written that if, when it utilize it, then only you can record the revenue. But in your case, the thing is different. Your performance obligation is basically doing the marketing revenue. not giving the package. Okay.
Yeah, but maybe the customer has not taken any benefit. I put the ad on the billboard, I put the Facebook campaign. Customer did not receive any business, for example.
Customer,
Customer did not
customer get the
did
benefit.
not
Let
get
me
any
tell you one
benefit.
thing. Let me tell you one thing. In your case, customer get the benefit when his marketing is done. This is his benefit. But for example, in the telecom industry, you give the package, but the benefit can only be utilized when he used that package. But in your case, when the marketing is done, the customer is the benefit because he wants the marketing and the marketing is done.
Perfect.
The
Perfect.
selling part relates to the sales agent, not the marketing agent, right?
Okay, but sometimes here it's standard also using agent versus principal. If you are
This
an
is
agent, then
different.
point
This
of
is
time.
different.
If you are a principal, then over
No,
the
no, no, no,
period,
no, no.
something like this.
This is very wrong concept. Agent principal is very different. Agent principal, okay, because we are on the step 5, so this discussion is worth it. I can tell you, I did not want to cover this section in this IFRS 15, but I can tell you agent principal is a very different concept. For example, when we were identifying the contract, we need to assess one thing, that either the two parties between which the contract is going to establish, those parties are the normal persons, or the other party is the agent to a person. Agent to person means that, for example, company A sells a product A to company B, and then company B sell that same product to company C, but there are some implications in the contract. So need to understand that company B has the full control over the product of product A. Like, let me make the example
For
simple.
example, in our case, the billboard example, we have
Yeah.
to subcontract the billboard. So we are working as an agent for the client.
No, no,
No.
no. Let me tell you why no. Let me tell you why no. Because there are 5 conditions attached in the IFRS 15, which gives you clear idea that you are an agent or not. That is, let's give me a simple example. Company A, company A asks company B to sell product A. Okay, and company A promises to pay the whole amount to company B. Now, company B took the product and sell to company C, the contract completed. Now, in this whole scenario, IFRS 15 gives you a guidance and tells you that you need to assess whether the company B has the full control over the product A or not. That is, like, if he does not have a full control over the product A, like he has the control, he can sell to anyone, he can use it as well. If this is not the case, this means he's just an agent and he's doing the service for company A to sell his product to someone else. That condition, I'm not stating those conditions today because I'm not covering this section. But if you go to IFRS 15, you can get those 5 conditions. There are 5 conditions uh, which concludes that you are an agent or not. And in your case, you contracted with the customer to give the marketing campaign. You did not contract it with the customer that from where you will go and arrange your marketing from your own subcontractor. If in your case the other customer knows that which is your subcontractor and he agrees to it, that you cannot go with any other subcontractor, you can only go with that subcontractor to do that kind of work, this means he is dictating you, and you don't have any control onto your subcontractor. If you don't have
Yeah,
any
I got
control
your
to your
point.
subcontractor,
One
this
one
means
of our
you are an agent.
Yeah,
Otherwise, you're not
I
an
got it.
agent.
Yeah, one of our auditor raised the concern about it on the campaign. Actually, they were of the stance that since you have agreement for 3 months, Maslan, for example, so you have the agreement,
Yeah.
contractual obligation is there, and you have a binding contract with the customer, and you have the right on the account receivable. So you can recognize in point of time all 3 months revenue in 1 month. Because on the other side, you have also contract with the Facebook, and you have paid the Facebook all the amount for 3 months. So it's okay. Facebook has also contractual obligation
No,
to run your campaign for 3 months. so you can recognize in 1 month. So it was very strange for me.
Sorry to offend your auditor, but he's of wrong. He's of wrong. He's on the wrong path. Revenue recognition does not relate to the cost you are paying. Simple as that. That whatever you paid the cost to the other party, it does not impact your revenue.
Or
Your
even,
revenue
or
is
even we
similar.
have the contract, binding contract with Facebook on the other side, and with the client also binding contract.
Exactly. No point in time, because in the service, I give you the simple thing. You can go to IFRS and check that the revenue for the service is only recognized when the services are rendered. And in your case, I know the difference will be very immaterial for the auditor, because there's only a cutoff issue will remain there at
Yes,
the year end.
exactly.
I was
Yes.
the auditor for 6 years. I know the things. So there will only be cutoff error will remain there. You got my point. So he's
And the
wrong.
difference will be immaterial. Yes.
Immaterial, but the thing is that he's wrong on. You can correct him. He's wrong. You cannot record point in time revenue anytime, because if that cutoff balance goes high, then there will be a very irrelevant presentation of your financial statements. That you will record you will overstate your revenue in the previous year and understate your revenue in the next year. You got my point.
Yes, and the chances of customer withdrawal or risk of customer withdrawal is always there. Customer can, at any point of time, there will be a conflict with the customer is not happy
Exactly.
with the services, or customer can say, okay, thank you very much, I don't need third month services, just 2 months is okay for me,
Exactly.
and I cancel the contract. So its revenue will be
Exactly.
overstated.
Exactly. And in agent and principal condition, if there is that thing, if they just confirm that you are an agent, then you can only record the commission, or the revenue will be considered as a commission, and no asset or liability will be recorded, because there is no
Yeah,
contract.
net.
There's just a principal agent contract. Okay. So I think this questionnaire is also good for the step 5, because step 5, I'm going to tell you about that how the revenue is recorded when all the performance obligation is satisfied. Obligation is satisfied on the current date or at the future date. If the performance obligation is satisfied at the future date, you need to assess whether on the future date the contract is satisfied over the period of time, means 1 month, 2 months. It's satisfying over the period of time, or it is satisfied at a single future date, or over the period of time, or it is satisfied at current date, or any single date. That is your point in time. The most important thing, when the performance obligation is satisfied, IFRS 15 tells you that satisfaction occurs when control of the promised goods or services is transferred to the customer. It's very important. The word control is very important here. In IS 18, the previous accounting standards for revenue does not tell you about the control. Let me give you a simple example. For example, you are a manufacturing industry, and you manufacture some goods. Okay. So when you sell those goods, when you can understand that revenue should be recognized, there are 2-3 stages. Like when you sell the goods, like first thing, you prepare an invoice of sale. The second thing, you prepare a goods dispatch note. Okay. The third thing, when customer acknowledge the receipt of goods into his warehouse. So there may be 3 dates. Invoice date may be different. Goods dispatch note may be different. Customer acknowledgement date will be different. Can anyone tell me when to recognize, on which date? Goods dispatch note date, sales invoice date, or customer acknowledgement date? On From the 3 different documents, when should I
Customer
record my
acknowledgement date,
revenue?
usually. Customer acknowledgement date, because risk and reward has been transferred to the customer.
Okay. Anyone else want to answer about it? Hakim is saying dispatch date, last dated. Depends on terms of sales. Mohammed Mirza is saying depends on terms of sales. Okay. Anyone else? Okay. Let me tell you, Mirza and the other guy. Irfan is saying customer acknowledgement. The most important thing is the control transferred. Dispatch date, transfer the control to the customer. If yes, then the dispatch date. Okay. Zaria, somehow you are very right on this part, that because the IFRS 15 is saying when the control is transferred. Normally, good dispatch note date and customer acknowledgement date normally is the same. 90% is the same date because it's not an export transaction. Normal local transactions, the date normally is different. The date and normally is different, but the control is 90 control is almost transferred in the case of manufacturing industry when the customer acknowledge the acknowledge that goods have been received onto the goods dispatch note. That date is basically the control transfer date. The dispatch previously in IS 18, normally the revenue was recognized on the date of goods dispatch note date. Now it's incorrect because goods dispatch note date can be different from the customer acknowledgement date. And if I go with the, for example, export transaction, you are doing revenue transaction to the other part of the world, then there is another document, that is bill of lading document. That document is prepared when the goods have been shipped in the carrier. So when do you record the revenue? Then it depends on the terms of shipping transaction. If like FOB, freight on board transaction, or any there are always inco
Also,
terms
please link it
involved.
with the service business also. How a service provider can divert the control to the beneficiary.
I will no issue. Okay, depends on that. It depends on that. uh, Depends on the inco terms of the shipping terms, that what are the shipping terms, because normally shipping terms are different. Like for example, when you transfer all the shipping goods to the carrier, there are some shipping terms which relates that now after you transfer the goods to the ship, then all the responsibilities and risk and rewards will be transferred to the customer. Now it is his responsibility. So at the date of bill of lading, you can recognize the revenue. So it depends on the incoterms while exporting transaction, but in normal transaction, customer acknowledgement is the date when you can recognize the revenue. As Suleiman asked me that also, I need to connect with the service industry. Service industry is the same. You need to assess when the control is transferred, when the performance obligation is satisfied. Like in his case, the marketing thing, the marketing when he delivers the marketing services for the 1 month, and 1 month service is recognized, he can record the revenue. Let me give you an example of gym. For example, you have you have paid the subscription for 6 months of gym. How, when the gym can record the revenue? Gym can record the revenue after each month. Okay, because after each month, customer cannot ask him that I did not come for that first month, please give me my 1 month back, 1 month money back, because he cannot ask it. So your service is to enable to let the gym open available to your customer for 1 month. If you do that, after 1 month, your service have been rendered, and the control for the consideration to the promised service is with you, and you can record the revenue that time. Okay, our Hakim is saying our term is CNF, and we are recognizing based on bayan date. I don't know what is bayan date. What is bayan date? Can you tell me, Hakim, please?
It's like a challan from custom authorities, Ibrahim.
What again? Sorry.
Challan from custom authorities, like
Customer authority.
custom authorities for the payment of custom duty.
Okay. So, okay, in this case, what I know about the CNF term, in CNF term, the customer is responsible for paying the carrier or incurring the cost of transport, right? If this is the case, this means that when you deliver the goods and services to the port, then now the responsibility is with the customer, as he is responsible for the shipping and everything. So at the date, I don't know, bayan date, he's right, bayan date is the custom date when customer declared that the goods are dispatched to the ports, and you're right, the revenue should be recorded on the bayan date, right, Salman? I think that's what I understand.
Yeah, but just to be clear, it's
Okay.
normally we can say it depends again. It's if it is bill of lading is the right word by the way, but beyond date is normally for imports, or I'm not sure if how he is referring to with exports basically.
Yeah, that's why I don't know about the bandit. I asked you. I don't know. Normally, bill of lading is the game thing, right? And GD, good dispatch. GD, basically goods dispatch. GD, shipping GD is prepared when custom declared that the goods have been reached to the port. There is a question: what if the contract is for 6 months, but no marketing service was done in third and fourth month, and all of the sudden it was done in fifth and sixth month? How we will recognize the revenue? Fahd Iqbal, good question. On the third and fourth month, when you did not give the services, you should not record the revenue for the third and fourth month on that month, and you can record the revenue for the third and fourth month in the 5 and 6 month. It depends on the customer. If there may be you can say gentleman agreement with your customer also. He may have stopped you for working for the 4 and 5 months and ask you to complete our service. But similarly, if he gives you your money at the end, then you can recognize the revenue at the end of that month for those fourth and third month, but not in that month when you did not perform the performance obligation. I think, Salman, we should end the session, huh? Because I don't want to go further in detail with the IFR 16. I just have a everything has been discussed. I don't want to go on the detail of this slides. It's already been discussed. Okay. The other slides are related to the other parts, and more questions will raise. I think we should end it to the step 5 model. And if anyone has another question regarding the revenue recognition, they can ask us right now, and they also have the contact of me and Salman. They can email us as well. Okay.
Yeah. Okay. I think there were two questions more, but we need clarification. So I send them messages if they can clarify more, or anyone else has question. We can open up the mic. Okay. I think question we have received so far.
There are no questions, then we
Okay.
can
So
should end the
meanwhile,
session.
if some yeah. Okay. So some of the participants are asking for the I can say time here. Okay. So some of the participants are asking that where they can find out this recorded session. So I always mention that you can go to Institute of Financial Accountants YouTube channel, and the recorded sessions are available. So normally it takes 5 to 10 working days to upload. The previous one has not yet been uploaded, so will be uploading together with this session, because now these I can say the whatsoever the topic has been discussed fully now. So we'll upload the videos recorded sessions, and if anyone requires um, the what I can say the presentation of this session, so you can send me either email or you can contact me over WhatsApp. I will share you the okay this presentation. I just typed my WhatsApp number in the chat box. You can see my WhatsApp number, and you can ask um, for the presentation as well. So and thank you so much, Ibrahim. This session was wonderful, and you delivered in an extensive way. And on top of that, Thank you so much, all the participants who joined, and we'll be in touch with you further with regards to all other, the more topics which we will bring in future. So, okay, thank you so much, and have a good night. I can say in Middle East, and we'll be in touch again. Thank you so much, everyone.
Thank you very much.